everyone. Welcome to another case study. I am doing this with you guys on 4/7/2025. So I'm going to start with the results on this one and then build up to them. So here's what we had. We have a software implementation company. We'll call the owner John, just to make it easy. And so here's what we've got. So the business generates around $11 million gross revenue, and that's 2024. We expect the same or higher in 2025. Then we have a profit of around 2 million, and with the owner taking home around 800,000 total. It is an S Corp right now, so taking about half and half distributions and salary. What we end up doing with this company, because it's high growth and the owner wants to grow it for a time before selling it. This is not a lifestyle business, though the owner does make a considerable amount. The end result for this, which is going to bear fruit this year from an yearly income tax standpoint, is we're going to save this client, an increasing amount in tax when you combine the entity and the personal tax rate to the tune of potentially around $150,000 this year, going almost all the way up to $400,000 or $500,000 in tax savings in future years as the company grows. And we are going to be able to get the vast majority of the sale of the company done without the client having to pay capital gains tax. So let's keep that in mind. That's a very attractive outcome. Now let's build up to how we got there. So the first thing we need to know, and I'll put links in the show notes to other content that I posted on these topics. So I'm going to keep it pretty high level. If you want a more detailed look, you can go listen to those episodes. But the first is to really start and look at a business's corporate election. So, the common ones being LLC, just straight up LLC. Then we have LLC sub S, or S Corp. Then we have C Corp. So let's look at just LLC to start. This is your classic, okay, we've started the business. Let's pick LLC because, what does LLC stand for? Limited liability company. There's no real tax benefit per se for having an LLC other than now you actually have a business and you can run legitimate business expenses through it to reduce taxable income, but it flows through to your personal tax rate. It's a flow-through entity. So that's your basic. The limited liability is also there because you'd rather them sue the LLC than flow through to you personally and try to take your house. So that can be a best practice there. Now, for a lot of businesses, mainly more lifestyle businesses or smaller service-based businesses, an S Corp can make a lot of sense because the S Corp, and there are many reasons for doing it. I'm just going to stick to what's in my purview. The reasons that I typically run into are that the owner can take more total compensation from the business and pay less tax. So in an LLC S Corp, there's a way for part of the compensation, which is distributions, to bypass FICA taxes. So that would be Social Security, Medicare, et cetera. That can be anywhere from a 10 to 12% that's not being applied to what's going out in distributions. So that's a best practice for lots of different kinds of businesses. So then let's look at the C Corp. So many people have heard of C Corp and they think double taxation because the C Corp is its own entity for tax purposes. You may have an LLC or an S Corp that has its own tax ID number, but for the IRS's purpose, it's just you. It flows through to you. With a C Corp, the IRS looks at the C Corp as its own entity. So, and there's a separate tax rate for C Corps. So you may be wondering, well, why would anyone ever want double taxation? Well, that's a good question. And the answer is really, if you want to grow the business to a point where you're making more in net income in the business than what you want to take as the owner, you start to look at, well, the C Corp is double taxation, but it's at a much low, but the C Corp is taxed at a much lower rate than personal. To be very easy and simple, we'll just use 20%, and state tax varies by state. So if a business makes $1 million net in profit, if it's an LLC, all of that net income has to be taxed at the personal tax rate. To be easy, we'll just say 40%. If the owner takes 500,000, but then wants to ram 500,000 back into the business, do you start to see where the problem is? Because all 500,000 that went back into the business is taxed at his personal tax rate. So all things being equal, if you want to ram more money back into the business, it can make sense to have double taxation because you want your business to grow and you would rather have that income be taxed at the corporate rate than at your personal tax rate. So let's keep those things in mind. The general thing is, if your business is starting to generate much more cash flow on a net basis than you need to take home, might make sense to convert to C. So the next thing we need to understand is qualified small business stock. Now, qualified small business stock is based on section 1202 of the tax code. And it says if you own qualified small business stock and pass a couple of tests, you can sell that qualified small business stock tax-free. Now, it does have to be an actual stock sale. If a business is sold as an asset sale and you hold qualified small business stock, you're out of luck. You may remember that the business that I'm working with is a software implementation business. So it's asset light. It's more likely that a business like that or a software business is going to be sold as stock rather than your asset heavy, like transportation and trucking company. A lot of assets on the balance sheet. Makes more sense for the buyer to make it an asset purchase. So the other thing about qualified small business stock is that you can convert an LLC into a C Corp. For simplicity's standpoint, I'm just going to go over the simple points. You have to wait 5 years. You typically need a very good CPA and tax attorney for this kind of work. But it's something that's very doable and it's relatively popular right now for companies that want to take advantage of this but aren't going to sell in the next 5 years. So here's the client situation. The company is owned by one person. The company is making 1 to 1.5 million a year net. The owner is only taking 6 to 800,000 per year. So there's a significant amount that's being taxed at his personal tax rate. So just in year one, we convert to C Corp. So he's saving around 170,000 in income tax because the amount that's being rammed back into the business is being taxed at the corporate rate while he maintains the salary and distribution that he had. And he has the possibility of, in the next, once 5 years has expired, to sell the stock that he has, which is now qualified small business stock, tax-free. which saves an immense amount of tax liability and makes it a lot more attractive for this guy. So this case study really goes over a bunch of different concepts, and the importance of that is it can't be overstated, just like how important having a holistic knowledge of this, like our firm does, so that we can put these different concepts together into one scenario or solution that really shines through and is a big win for the client. All these things are great on their own, but it's being able to combine them that really, really helps folks. So I will link to all the content that is mentioned in the episode, and I appreciate all of you for tuning in. If you found this valuable or applicable, please click the Contact Us button below to answer a few simple questions and get scheduled with a Bloomwood advisor to discuss your unique situation. The information covered and posted represent the views and opinions of the guests and does not necessarily represent the views of Bloomwood. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for financial, legal, or tax advice. Always seek the advice of your financial advisor or other qualified professional with any questions you may have. Bloomwood is a Georgia and North Carolina registered investment advisor with its principal place of business in Atlanta, Georgia. Bloomwood and its representatives are in compliance with FINRA and state regulation in the states where Bloomwood maintains clients. Bloomwood may only transact business in those states in which it is registered to do so or is exempt from registration. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same result. This content does not constitute tax advice, legal advice, or financial advice, and does not create an advisor-client relationship between Bloomwood and the listener. This case study is designed to give you an overview of the impact that proper tax and financial planning can have on your financial life. The figures in this case study are not calculated to the exact penny and are designed to facilitate a conversation.